According to the International Monetary Fund Managing Director Kristalina Georgieva, the outlook for the global economy has darkened significantly since the month of April. She says that we are in very choppy waters, citing a more universal spread of inflation, more substantial interest rate hikes, a slowdown in China, and escalating sanctions related to Russia's war in Ukraine. And given those elevated risks from inflation, rising interest rates, and the worries about what's happening, she couldn't rule out a possible global recession next year. She said we need to create the same strong level of coordination between central banks and finance ministries so they provide support in a targeted way and don't weaken what monetary policies are aiming to achieve. Well, now this was interesting and it was well timed because it came as the Federal Reserve released the minutes of its last meeting, showing that officials in June emphasised the need to fight inflation, even if it meant slowing an economy that was already appearing on the brink of recession. Participants, the statement said, recognised that policy firming could slow the pace of economic growth in the US for a time, but they saw the return of inflation to 2% as critical to achieving maximum employment on a sustained basis. Now, that was what was said in that statement. Let's take a look at the chart, because I want to bring up this chart, first of all, of the S&P 500. Now, you can see that despite these warnings and the emphasis on the expected recession, we've got a market that's rising, and we see this pretty much across Europe today. And this is the S&P 500, just to give you a broad idea as to what's happening. 24-hour markets trading on the IG platform before the US markets get underway. We've got a fairly good idea that we've got a positive start coming, because we see on this chart here, this rise that we've got here again for the S&P 500. Now, where do we go from here? Well, clearly there are headwinds ahead, and we see this move up, but we've also got this trend that's in place here from the highs that we had back in the 30th of March. And I'd want to see this market rise above this with a candle close above this line of resistance before then beginning to start to feel that we're out of the woods. And that means rising above this high point we had here back in the markets at 39.46 back on the 27th of June. Until we get there, I think this is just a small retracement in what is otherwise a market that persists on the downside. Now, this isn't the only market of interest as a result of what we've been hearing today. Look at this. This is euro trading far weaker again against the US dollar. Look, there's a little bit of money going in, but the broad sweep is we've got the dollar rising against a whole basket of currencies, and we're now at pretty much not too far away from the weakest point we've been for the euro against the dollar in 2 decades. Next stop, or many consider that we are now at 101, that we could well see a 1-to-1 parity with the US dollar in the coming months, sometime over the summer. But whichever way you cut it, the IMF and the Fed agree that fighting inflation is the #1 target.